The freezing fog had barely lifted when the gloom descended on London's scandal-prone banking sector. This time a record £28 million fine for the Lloyds Banking Group, a clutch of the country's favourite and before now most trusted names, including the Bank of Scotland and Halifax. The fine was increased by 10% because Lloyds continued to turn a deaf ear to warnings its staff incentive schemes were putting customers at risk. So despite repeated warnings from the financial authorities, the bank's managers continued to pile on pressure on their sales staff, driving them to mis-sell products to their customers with financial incentives like the champagne bonus or the grand in your hand scheme. One financial advisor was so desperate to meet his monthly targets that he sold insurance to himself, his wife and a colleague. The banking group had repeatedly promised to get its act together. In 2012 it said, "From the start of this year we have made significant changes to our incentive schemes. We reward behaviours that are focused on achieving correct customer outcomes and excellent service." And a year before that it said, "Halifax is committed to operating with the highest levels of integrity and treating customers fairly." And 6 months before that statement, "Our relationship with our customers is at the heart of our business. There are areas where we can improve, and we're working with our customers to do just that." No wonder then that its customers are losing confidence and trust.
The schemes that were in place ran the risk that the advisors would be encouraged to sell products to customers in order to meet targets, rather than really thinking about whether or not those products were right for the customers concerned. And the schemes baked into them some pretty significant cliff edge effects, so that you could be automatically demoted and taken down 20% of your basic salary if you didn't meet sales targets, or on the other side of it, if you made your sales targets, you could have a significant uplift on your salary.
But isn't that how all bonus schemes work?
The way in which bonus schemes work is that they should take into account not only whether you've made the sale, but also whether or not the sale was suitable. And one of the failings we found in the way that Lloyds had monitored this was that they didn't take into enough account of suitability. So you could make unsuitable sales, you could even have complaints upheld against you, and you could still end up getting a bonus.